All right, for our project, we examined the current financial situations of AB InBev and Molson Coors, which are two of the top beer distributors in the world. I'm Stephen Kent.
Jack Schmidtline.
So our first company that we looked at will be AB InBev. This is currently the world's largest beer manufacturer, which merged in 2015. It was a combination of Anheuser-Busch, which based out of St. Louis, Missouri, in the United States, and was a family, privately owned, operated brewership. And in 2015, they decided to go public when they merged with InBev, which was based out of Belgium. Currently, their most popular brands include Budweiser, Corona, Bud Light, Stella Artois, and Modelo. They have a pretty good diversity globally. You can see a lot of these brands historically, like Budweiser and Bud Light specifically, were commonly found in America, but have since this merger in 2015 have gained a lot of exposure in European markets as well as Africa and Asia. Um, the headquarters right now are in Belgium. And our second company is Molson Coors. This merger happened in 2005, sort of similar on a less smaller scale, however. Molson was a beer distributorship based out of Canada, while Coors was owned and operated by the Coors family in Denver, Colorado. And after going public in 2005, merged together where their current headquarters is in Chicago, Illinois. So they have a strong foothold in North America, kind of moving less volume and just sort of aren't as big as Anheuser-Busch. And so their popular brands are Blue Moon, Coors Light, Miller Lite, and Keystone Light.
So taking a look at AB InBev's balance sheet to start with, we first look at their asset column. They have a strong liquidity position. As you can see in 2019, they increased their total assets by 57%, which as an analyst is something we like to see. That's a very important part of the firm. It shows how liquid they can be. So that's something we really like. And then we move down to the liabilities and shareholders' equity, and we can see that total non-current liabilities decreased by 7.8%, while current liabilities pretty much stay the same in both years. So that's also a great thing to see. That means like long-term debt and commitments and contingencies that are over a year decreased, which is something that you want to see within the firm. And then within owner's equity, we really like to see that retained earnings increased by 20.8% over the year period, which is great. That's connected to net income, of course, from the income statement. So it shows that they're with the money they're putting in, they're making a profit on it. And so the overall analysis of their balance sheet, they're in a great liquidity position. They're decreasing their non-current liabilities, and they're making a strong hold on retained earnings. So overall, they have a strong balance sheet, and 2019 was a great year for the firm. Then we look at Molson Coors' balance sheet. First, we look at, again, assets, and we see that they have kind of a liquidity concern. So their current assets decreased by 21% in 2019, which is not very good. Obviously, a firm's current assets kind of dictate their liquidity position, and you always want to have current assets on hand. So that's not good that it decreased by 21%. And then we see that their total assets decreased by 4.2%. This can be attributed to their cash shortage and cash equivalents. You can see that it only took up 1.8% of total assets, which is a very small percentage, and that it dropped 50% from 2018 to 2019. So they lost a lot of cash. So you might ask, why would they lose this much cash? So if you go down, you can see in the liability section, their current liabilities dropped by 14%. So we can infer that the firm used a lot of their cash over the year to pay off their short-term debts. So although their cash decreased, we can see why it decreased and have a story behind it. So it's good to see that they're paying off their debts. And even though their assets decrease, which we don't like to see, we also see that their liabilities are decreasing. So that's positive. And then we also see that their non-current liabilities are greater than their current liabilities. So again, they're paying off more of their short-term debt, and they're leaving their long-term debt for more. Their long-term loans are up 40% from the year. And like I said, current liabilities are only 12.8% of total liabilities and owner's equity. So it's really not a lot in the scheme of things, and something we like to see. Now we turn to profitability, the income statement. So starting with AB InBev, we see that to begin, the revenues decreased slightly by 1.3% over the year, and their gross profit decreased by 3.4%. Not necessarily great. We like to see an increase in profits, revenue. So we want to go down the line and see how that affected the rest of the statement. So we see in the SG&A expenses and operating expenses that they also decreased slightly by 3% from 2018 to 2019. and that their total expenses take up roughly 30% of the revenue. So that's something you like to see. That number can range, but that's not a whole lot of percentage of total revenue. So that's not something to be too concerned about. And then we look at their earnings before tax levels, and they increase drastically. And this is where things get interesting. So as you can see in the other income expense column, they basically increased that by 158%, which is extraordinary. So that alone really helped their EBT levels, and then therefore their net income increased by 93% for the year. So it was able to retain 19% of their total revenue for net income, which is that's a high retained earnings. So, and we saw that in their balance sheet. So overall, they had good profitability. Again, we would like to see increases in revenue, although we don't see it here. We see that they decreased their expenses slightly, which is good, and that they had other income increases in their EBIT levels. So overall, solid profitability, and we see that net income increased. And we look at Molson Coors income statement. Their gross profit increased by 0.4% despite a loss in revenues as well. And this would be attributed partially to lower cost of goods sold. So even though they had a drop in revenues, their cost of goods sold also decreased with that. So therefore, gross profit wasn't affected that whole much. Then we turn down to SG&A, and this is where things get a little shaky for the company. So their total expenses in this column increased by 34% from 2018 to 2019. That's not something the analyst wants to see, because this shows that the revenues are decreasing, but their expenses are increasing. So they're losing money with less volume of revenue, and they're also paying more money in costs. This is a recipe for disaster in a lot of companies. So to kind of recap that expense column, it took a 32.5% of total revenues, which is quite a bit. And so that would lead to their earnings before income tax levels being drastically low. They dropped by 54% from 2018 to 2019. And then their earnings before tax level also dropped by 65%. So those are huge percentage drops, especially in those metrics are very important in these statements. So that's something that's a cause for concern a little bit. And then we see that as a result, their net income dropped by 73% in 2019. And again, a lot of this can be attributed to cost of goods sold and selling and administrative expenses taking up 90% of revenue. So you're seeing that 90% of your total revenue is being paid off in costs. That's something that the firm in the future needs to look to minimize for sure, especially if their revenues are taking a hit. They have to find ways to reduce their costs, or else they're going to continue to take decreases in net income and lose their retained earnings, which is something that's not good for the firm in the long run.
As far as recommendations and analysis go, the first part we looked at was which company would be in a better overall position. And as of right now, it looks that AB-InBev has the edge over Molson Coors. They have a good balance between their assets and liabilities, and a solid increase in income with a lot of cash on hand, where over the past year, Molson Coors experienced a decrease in assets, lower volume of cash, and a decrease in overall capital. AB increased capital, as previously mentioned, Molson Coors decreased theirs. So you're sort of looking at historical trends and whatnot that has been to both firms, and it seems as though AB InBev has the upper hand with being a larger firm and also just having years of more stable increase in profits, revenues, and balancing their assets versus their liabilities. As for recommendations to investors, lenders, or future employers in these corporations, these are sort of, I'll highlight the positives of AB InBev and why this will be good indicators to invest in AB InBev over Molson Coors. First and foremost is the diversified portfolio. They are a major global market and can dominate markets from, so before the merger in the company, we have Anheuser-Busch that just completely dominated the United States beer industry with their Bud Light, Budweiser, and manufacturing in St. Louis, Missouri. They had a strong foothold, and once 2015 came around, Austin Busch III, who was part of the family company, decided he wanted to make the company public, and so they merged with InBev and increased their overall sort of power from a global sector. And so they were able to combine with InBev and which is located in Belgium, and crack into European markets from the Anheuser-Busch side of things and distribute across Asia, Africa, and throughout the rest of the world. As well as they have a pretty good hold on local brands such as Blue Moon, which is sort of a smaller sector that they were able to buy out that still has a strong foothold throughout much of the United States. And secondly, their efficiencies with capital, sourcing, purchasing, production, and marketing. these are sort of the five sectors of sort of any business, whatnot. And Anheuser-Busch seems to have the upper hand in all of them. With capital, obviously, they have more cash, which equals more purchasing power and sourcing, which they can get out to different parts of the world and into different markets. And production-wise, they can just increase in more factories and whatnot, and just continue each year and year to invest more money into operating activities and financing activities. And as far as marketing goes, they just sort of seem to be one of those staple blue chip companies where if you turn on Super Bowl or sort of any main event on TV, you're most likely to see, you're definitely going to see some beer commercials. But as far as Anheuser-Busch goes, they seem to have the top notch and always have people talking about their products. As far as historical performance, I mentioned they've been around for a while in the United States and had the strong foothold. And with their recent merger with InBev and going public, they've just totally increased their strength and foremost on a global platform versus when they were more domestic wise. So Molson Coors also has a good foothold in the United States and North America, but they just are sort of at a disadvantage being restricted to only North America. You'll see some of their products abroad, but it's tougher for them with their headquarters in Chicago versus AB-InBev being familiar with the territories in Europe and being able to crack into those markets. And as mentioned, strong capital and cash on hand. It's pretty obvious you're going to want to be with a company that has more to do, willing to take more risks, take on more companies to add to their firm, and just sort of expand that brand name that is AB-InBev. And lastly is the innovation and shared knowledge as a global corporation. It's a larger entity, so they have more experience at different stuff. They're more adverse to taking risks and selling in newer markets just based off what they've done in the past. So it's just sort of strength in numbers type thing where you have more employees, more people, more products going out, and just increases your overall capital. So one of the learned projects, as I mentioned, was that both these companies are very strong in the United States. They're the two top ships in America, but the upper hand is given to AB InBev being a more global company. They have their headquarters in Belgium. They're easy to access throughout Europe. And so that sort of gives them the upper hand here. Molson Coors is a great company, a great stock to invest in. But if you were given the chance, one of the two, I would say AB InBev would be a better bet. Another thing we were able to do is that we just applied skills that analysts would use in the real world by looking at the balance sheet and income statements and sort of analysis and seeing a year-long trend between two firms that are in the same industry, and seeing how external factors such as whatever's happening, such as pandemics or a recent decline in the beer industry, can hurt the market, and how firms can sort of adjust to that and whatnot. So one of the things that we saw, these external factors, was how Molson Coors sort of recognized that they needed to have a better foothold in the beverage industry, and sort of expanded from just beer and are looking into drinks like seltzers and whatnot to appease younger generations that aren't drinking as much beer as the past. And then also we were just able to see from class, activities from class or homework, and just sort of connect them all together and compare these two firms. And as mentioned, the beer industry is hurting, but both these firms are stable and leading their respective markets. I think that Molson Coors should focus on their profitability and improve their retained earnings. This would sort of help them in the long run, while AB InBev has just sort of had the stronger profits and success over the years. And they're only recently 5 years from merging with InBev, sorry, as Molson Coors has been together for 15. So, I mean, the sky is the limit for AB InBev, and I think taking on that stock, you can expect to just sort of wait it out. They're going to take on a lot of debt, like most industries are experiencing right now with the pandemic. But as far as the company itself goes, it's been a blue chip stock for years, and there's no reason to think that's not going to change.
All right. Thanks for listening.